Hello, hello, everyone. Brandon Jones here with Gravy. I'm very excited to introduce an old friend of mine who is a Yoda when it comes to personal financial management, Mr. Arthur Johnson. This conversation is called Assets Over Hours, Building a Real Estate Portfolio While Climbing the Corporate Ladder. Now, AJ is somebody who I've known for a very long time. He's been in many ways almost a financial mentor to me. And there's a lot of areas that he can cover, but we're diving into what ultimately was a big factor in him retiring early at 52 by amassing a real estate portfolio of uh, over 53 units across 3 states as he was working as a busy corporate exec, most recently chief strategy officer at Pure Storage, but a long executive history before that. Family man, sits on boards, a bunch of other stuff he does, mentoring, etc., along the way. This is our second conversation, but in this one, we're really going to dive down and unpack how he actually executed this strategy. Because a lot of folks in our community, real estate is, depending on the survey we take, the number one or number two area that people are most interested in terms of acquiring real estate, such that they can build passive income and ultimately generational wealth. So, with that, want to welcome brother AJ.
Hey man, thanks, Brandon. Always good to talk to you, man. Looking forward to this conversation.
Yeah, man. So I'm gonna take it back. I met AJ probably 2013. He was one of the first folks I met out in the Bay. I think it was a political fundraiser I stepped into, and we met, we connected, and then he took me to another place with him, and we've been kind of tight ever since. Um, and at the time, he's always kind of been. I think it was at Andreessen Horowitz at that time. He's always been doing his thing professionally, and that's kind of his reputation. But his real story, I think, is the most fascinating aspect of his background. Is as he was kind of executing these power moves in corporate, he was very, very intentionally building a portfolio of assets. But really, the real estate piece, I think, is what's most interesting. And a lot of people didn't really know this about AJ, and I kind of got to know it as I got to know him. So let's just start off with your background and then tie it into the strategy that you put in place as you were working corporate. What was the genesis of the roadmap that you knew you wanted to build out to get you to retire basically at 52? So just start from the beginning and help us understand how you frame this whole thing, this whole vision.
Thanks, man. That's a great place to start. So, I'm a first generation American. My parents were born and raised in the Caribbean, Trinidad and Tobago. My sister and I were born in New York. Unfortunately, when I was about 7, 8 years old, parents got divorced. My mom wanted a fresh start, and so we moved out to Los Angeles. And so this is where I kind of started to really blossom. Really, LA, better weather, sunshine. Played sports in high school and college. But I was kind of a weird kid. So in high school, if you can believe this, I used to read the Wall Street Journal, New York Times, and LA Times cover to cover every single day.
Wow.
It was
Next level.
crazy. It was crazy. I don't know what it was, but I just soaked up all that information. The
So
entertainment
there was no
section.
family member, no mentor who kind of
No,
this is what
no.
you
It
do.
just is like all it's like the real estate section, the business section, the sports section. I just soaked it all up, and so that was like the knowledge base for me. And when I was playing baseball in high school, we were outfitted in Nike. We had Nike, gear and etc. And I had an opportunity to invest in the stock market based on my reading and stuff. And the very first stock I bought when I was 16 years old was Nike.
Mm,
And Brandon, I have not sold a share of my Nike
wow.
stock. I still got it. And so
So
that
you've been
kind
doing
of helped
well
me.
just on Nike stock.
Yeah, so that kind of helped me think about, okay, what do I want to do as an adult? What do I do when I grow up? And so majored in finance at undergrad. And then I worked as a bank analyst for the Treasury Department for 3 years after undergrad. And I really kind of got a good grounding in how to examine a balance sheet, how to examine an income statement, how to examine cash flows for banks. Spent 3 years doing that across the country. And then I decided to go to business school at Stanford, where I wanted to kind of start to get where I got bit by the technology bug, where I wanted to marry tech and finance together. So I spent 5 years in investment banking advising tech CEOs. And this is where I was first introduced to real wealth, right? This was like doing the .com, and I saw these CEOs making a lot of money. And I was always the curious kid asking, what are you doing with your money? How are you investing your money? And that's why I understood how the wealthy people were doing with their investments. And so when I started working in banking, it was a lot of hours. And then I decided to go work for one of my biggest clients, Hewlett Packard, because I wanted to really be a different kind of dad to my 3 daughters.
Mhm.
And this is when I first kind of felt like working at Hewlett Packard was a big company, but I felt like a small cog in the wheel. I don't think I was really valued for my work at Hewlett Packard. And then one night, 9 o'clock, working on a big deck, one of my colleagues was working on an offer for a real estate property. I said, what are you doing? He said, I'm buying this property in Sacramento. I said, why are you doing that? You guys already had a house in Palo Alto. He said, no, this is an investment property. I'm trying to build my cash flow because I want to make sure I retire from HP before I sell my soul to the devil. And
Mm-hmm.
so this guy walked me through his offer. He walked me through his strategy, and he walked me through why he was doing it. And that's when I first got introduced to the concept of building passive income to not be beholden to a W-2 employer. And that lit the fire. This is like back in 2003. And and a whole new world opened up for me. And so ever since that day, I said, what can I do? And so that's when I began my journey, And so I said, I didn't feel valued. I wanted to create a passive income stream that can cover my expenses so I can be a bit free from a W-2 employer. And starting in 2003, 2004, I started my journey to build this real estate portfolio.
All right, let's fast forward to the future now. So this is your second conversation with us.
Mm-hmm.
Your first conversation, you were still in corporate.
Mm-hmm.
Tell us where you are now. What are you doing today that these decisions you made, how long ago, maybe 12, 15, 20 years ago, have put you in a position where what? What are you doing today?
So I'm happy to say that now I'm fully retired from my operating job as of last year, 2023. I still do board work. I'm on two boards, but because of my real estate portfolio and other passive income, I'm able to be financially free from a W-2 employer. And I got it. It's the best decision I've ever made because the biggest thing is control. Like working in corporate, I didn't really have a lot of control over my calendar, even though I was a senior executive. But now every single meeting I have, I I'm in control of. I want to have that meeting. And so it's been a good decision. I'm working out more. I feel healthier, getting much better sleep. I'm connected with my wife and my kids better. It's been Brandon, it's been just a great,
All
great
right, man, that's
decision.
enough. You're making us. So you were retired at 52.
Yeah.
When did you start this process seriously? How many years did it take from you to get from that beginning to where you are?
Yeah, it's a great question. I think so. I think I started in earnest at like 34. So a little late, right? So these other folks coming up now with the fire movement, they're starting at 22, 21. So I started a bit late at the 34, 33, 34, but I was diligent about it. I attacked it like it was like an M&A deal I had to do. I
Mm,
attacked it like a big corporate initiative. And
mhm,
so, and that was the biggest thing. I was consistent about it. My wife kind of signed up and kind of got her buy-in on it. And
mhm.
so because we're consistently able to kind of buy a property here, buy a property there, build up other passive income streams, it paid off 20 years later, almost 20 years later.
Got it. So,
And I got to say, I think that I could have retired earlier, but I kind of got on a few years of a one more year syndrome. One more year of payday, one more year of the RSU vesting. And
the
so
Tom Brady, the Tom Brady.
exactly. So I got caught up in a few of the one more years, but
Yeah.
yeah, I pulled the plug at 52.
All right. So let's talk about that true north. How did you define what the point where you could step away is? Whether that's some metric of expenses or whatever, but like for someone who's like, okay, I'm interested. Let me kind of clarify what this actually looks like. What was the goal that you actually set?
Yeah. So there's two aspects to stepping away. One is the practical, the numbers, but one is psychological. And the psychological one is even more important than the numbers. Okay. Because I was caught up in this myself. Like my identity became my job. Like I identified myself by my title, my pay, and that's not a good place to be. I
Mm,
had to separate my identity from my job and realize that I was not my job.
mm,
I'm an individual, right? And I had to go through this process to define what is my life mission, what do I stand for? And once I did that, I felt more comfortable that hey, I can step away and still function as an individual.
that's
Okay. The second part was the financial piece. And so the goal that Nicole and I set up, she says, listen, you can do that, but I don't want to sacrifice my lifestyle. So we can kind of retire and put us in a position where we can spend the same money we spend pre-retirement, post-retirement, I'm on board. So that's we kind of say, okay, what's our number that we want to cover every single month? If we can do that, that's what we did. So once we kind of got comfortable with that number, which included a margin of error, margin of safety, we did it.
Got it. Okay. So a lot in there. We're gonna unpack it. So the first thing that kind of caught my, ear was this idea of the identity piece, not just the
Yeah.
financial piece, which I think thinking about it, a lot of us can relate to. I know I can as well, right? Particularly if you're underrepresented, you went to Stanford, you worked at all these kind of big brand places. That becomes a big part of who
Yeah.
you
Yeah.
are and how other people perceive you, right? So
Mm-hmm.
this idea of um understanding your value outside of the label or the platform you're part of is interesting. Um,
Mm-hmm.
the second piece is there's like these ingredients you had. So the one was alignment with Nicole, your wife. She had to be on board, so
Mm-hmm.
you were going in the same direction. And you also had to have clear criteria that she was aligned to that
Mm-hmm.
allows you to make this next step.
Mm-hmm.
And so, but I think what you boiled it down to initially was this mentality. And I want to kind of go into this mentality. You said I attacked this thing like I'm on an M&A team, an
Mm-hmm.
investment bank, and I'm going hard.
Yeah.
This is the part where I think a lot of people fall or falter. So I want to kind
Mm-hmm.
of get to the underlying drivers slash values that you think are foundational to being able to kind of keep it up for the marathon in the long term. So can you
Yeah.
speak a little bit around when it boils down to it, what is the difference between people who say that they want this as a goal and people that actually execute on it? What is the playbook that keeps the momentum building such that they can sustain this for, in your case, 18 years?
Yeah. So I think the people that don't take action, the primary reason is because their why isn't big enough and important enough. My why was freedom. And for whatever reason, it meant everything to me. And so I was going to do whatever it took to get to that freedom. Right. And so my why was sufficiently big enough. If your why isn't big enough, it's gonna be tough and you're gonna give up. You're not gonna get to it. You're not gonna take the time to kind of do it. So make sure your why is sufficiently large enough to motivate you to keep on going through the tough times. That's number one. Number two is you gotta begin with the end in mind. For me, it was about passive income, cash flow covering our monthly expenses. Very specific. Okay. And so if you're not clear about why you're doing this and what you're doing it for, it's going to get kind of muddy and you're not going to be able to set the right goals there. So once we kind of said, here's my why, here's what we're trying to do, then all I got to do is devise a plan to get there. And I looked at all kind of things other than real estate too. I looked at the time like an eBay business, selling stuff on different kind of marketplaces, doing wholesale real estate, not buy and hold. And so, what my criteria was, I need something where it's not going to take up a lot of time. I need something where it's going to be tax efficient. I would need something that's going to be leverageable and a stable asset class. And for me, buy and hold real estate hit every single criteria for me. But again, buy and hold real estate is not for everybody. So I want to make sure you guys think about what's your why, make it sufficiently big, and think about what the end goal is. Maybe the end goal is I want to generate a lot of wealth, and appreciation could be the way to go. I want to be an investor. I like the stock market. I want to be a trader. So again, real estate is not for everybody, but for me, it fit every single criteria for me.
I love that because I think what you're bringing up is a really deep look into what is authentically going to be something that is suited for you, right? So let's say, you mentioned you were reading New York, Wall Street Journal, all these things in high school. You probably were seeing stories of, Reginald Lewis, big buyouts, right?
Yep. Yeah.
Ultimately,
Exactly.
you're a
Yep.
family man with three kids. You saw as a banker, that wasn't really in your mind the ideal life. So you matched what you thought, you could do. It will be uniquely suited for you. And it wasn't about, becoming a billionaire. It was about how do I balance something that can allow me to provide, build a lifestyle that I can, spend time with my family and also, retire early and kind of enjoy, call it the last third of your life the way you want to. And I think that's really important.
Mm-hmm.
So let's talk strategy because within real estate, your story is interesting. A lot of people when they first dabble in real estate, and I have a little bit of background having done some residential real estate as well back in the day. Um, finding a property that cash flows, right? That's kind of like the core bread and butter. A lot easier said than done. And ultimately, your model was buying 1 to 3 unit properties across 3 states that you were basically managing with teams on the ground
Mm-hmm.
remotely as you worked. For a lot of people, I mean, would that be a fair description of your real estate portfolio strategy?
It is, but I didn't start there.
Okay, tell us
I
more.
started I started with, hey, I'm new at real estate and I want to invest in my own backyard. I wanted to invest in Oakland. I wanted to invest in and I looked at all different areas within California. I went to Modesto, Fresno, Bakersfield. I went to Sacramento, and I couldn't quite find properties that fit my criteria. And in hindsight, it may have been the wrong criteria because I was looking for a combination of appreciation and cash flow in the same market. And I
Mm,
realized that that's really hard to do.
mm-hmm.
And so I looked at all these different properties and I couldn't find it. And I didn't want to pull the trigger on something as my first property and fail. So then I started to look beyond California, close by California. And I did that based on creating this huge spreadsheet that looked at population growth, income growth, the vacancy rates, et cetera. And I said I honed in on a couple MSAs that kind of hadn't fit my criteria, and it ended up being in Texas and New Mexico, of all places.
Mm,
And I chose that because I wanted to be able to get to those areas in a day. I want to be able to fly there and back in one day. I don't want to go to the East Coast of Florida, things like that. So I said, if I can kind of stick with a get to fly to Albuquerque, come back the same day, that's great. So that's why I kind of honed in on it. But again, I started with my own backyard because I didn't know how to do it remotely because at that time there wasn't a lot of like email or videos and things going on. So it was gonna be harder to do it remotely, but I couldn't find a property that fit my buy box. And so I had to go outside of California. Once I started going outside California, I realized that it's going to be even more important to have a good team on the ground. And that's why I started kind of building out what does that look like, et cetera.
got it. So a lot in there. And one thing I want to just kind of put to the audience. So by the way, if you have questions, feel free to kind of message me those questions, and I'll make sure AJ gets those during the session. But we're talking about some of these fundamental structural analyses that you put in place, so you can easily understand whether or not a market or a real estate investment made sense, right? And you exercise a level of discipline based on that criteria that you stuck to. You traveled to a lot of places. You didn't allow yourself to be swayed, against your thesis. You may have refined it, but it was never based on emotion. It was always based on clear criteria that you needed to meet. And
Right.
so, one thing I wanted to say to the folks in the network, I'll be working with AJ to kind of define what that list looks like of criteria, some of the foundational elements that can help you shape your strategy as you kind of start this journey. But the second piece of it is I want to talk about this discipline element of things. When you get down to the weeds of it, what ultimately were the thresholds that you were looking for? Was it an IRR? Was kind of help us understand how you kind of thought about this? Yes, yay, nay. Just
Yeah. Yeah. So there's two things I developed really early on in my process to help me quickly evaluate deals. I built a quick and dirty model and a more kind of detailed model, right? And the quick and dirty model really kind of helped me understand the quick criteria of like, hey, can I get a 15% cash on cash return on this property? And do I think this will appreciate 4 to 5% a year, right? Again, the mistake was looking for both in the same market. I think you can look for those separately in different markets. And so looking at Albuquerque or New Mexico, I initially thought, hey, I can get 50% cash on cash return and this 3 or 4%, 3 to 5% appreciation. And so building those two models helped me to quickly evaluate properties because I was getting tons of things thrown at me by realtors all the time. And to quickly process that, initially I was just I was kind of doing it by hand and doing it all the time, one off. But I said, this is taking too much time. I'm still working at my job. So I built these two models to help save me time to quickly evaluate these deals. And then once I started to find a suitable property, which I thought met my criteria, I bought my initial property in Albuquerque, New Mexico, and then I bought properties in Texas. And the good thing is that the Texas properties actually worked out pretty well. The New Mexico properties worked out okay, but I've since then kind of sold the New Mexico properties and transitioned that into Midwest cash flowing properties. But I think the initial thing was having a clear criteria, like what is going to be your criteria for exactly what is an attractive market, building a quick and dirty model to quickly evaluate these offers initially, and then having a more detailed model to really evaluate what's going to be what this thing's going to look like once I own this thing, and then it was off to the races.
Got it. If you're doing it the right way, how quickly should you be able to use a quick and dirty model to decide quickly yes or no?
5 minutes.
5 minutes. Okay.
You put in the purchase price, you kind of assume the debt, how much the debt's going to cost, the rent vacancy rates, quick, and if it hits 15%, good. You look at it even further. If it doesn't, on to the next.
Okay. And your metrics were pretty aggressive. 50% cash on cash is obviously
Yeah.
you know,
And,
uh,
and I got there because I felt that I can get like 8% return in the S&P 500 index, for the most part. And that's totally passive. To compensate me for the additional risk and time, to invest in real estate, I need to have something beyond that 8%. And that's kind of how I got to that 15% cash on cash return.
And to me, I think there's a big kind of takeaway here, which is you were very clear about what a win was for you, right?
Yeah.
And you were like, my discipline is anchored on what I feel this is, needs to be worth for my time and the effort that goes
Right.
into it. And then anything that doesn't meet that as a no. So you might
Right.
see 100, 200 properties before you say yes. You were
Yeah.
comfortable with all those new no's because you knew at the end of the day you would find something that met that criteria. And I think that's a really important point to
Yes.
drive home, was how
Yeah.
selective you were in a world where it seems like maybe you would have been too selective.
Yeah.
And then the other piece of it, is, as you were kind of thinking about now with the lessons you have, cash flow versus appreciation, any reflections on that now for people first starting? You mentioned like in the same market. That's a little bit too much to ask. Clearly, there's ways to make money in commercial strip malls, right? And there's ways to make, there's a lot of ways to make money in real estate. But
Yeah.
knowing what you know now, for people kind of starting to explore, any reflections or any guidance you would give on just the ideas of kind of appreciation versus cash flow, or anything else that you picked up along the way?
Yeah. I think from my perspective, appreciation feels riskier, right? I kind of view appreciation as more icing on the cake. And so I think that in markets like Nevada, Florida, where they have these great demographics, great trends, appreciation will happen. It's kind of probably going to happen in waves, but it's probably going to happen. But I can't eat appreciation. I can't like use appreciation to buy dinner for the family.
Mhm.
And so to me, appreciation is harder to monetize. And so for me, I focused on attractive markets where I can cash flow. And if there is appreciation, that's great. I can kind of use that in different ways, but that's kind of like I view appreciation. And again, that's not for everybody. I think that there's some investors that have been very successful that have focused on appreciation and they've done well. Again, it's not something that it's bad, but for me, it felt riskier because my goal again was passive income,
Mhm.
not passive appreciation. And
Yeah.
so I think that's one lesson is like, not finding it in the same market. Appreciation can be riskier. I think another lesson is the asset type within real estate, right? And so I looked at like single family homes, looked at some commercial properties, looked at some fourplexes, triplexes, but I found the ones that had the highest vacancy, the highest occupancy rates, the lowest vacancy rates of the single family homes because you tend to attract a family. And families are much stickier than people living in one bedroom, one bath apartments, right? They typically either single or it's a couple with no kids. They can move every year. And the biggest impact to your profits as a cash flow real estate investor is turnover. You'd rather keep the rent the same to keep the tenant in there than raising the rent $100 a month because that turnover can cost you anywhere from like $1,000 to up to $5,000. That could be a whole year worth of profits gone by one turnover. If you have
Okay.
the turnover every year, it's not profitable. So that's why I think that attracting families are much stickier than single people or couples with no kids.
Got it. So as a checkpoint, you looked everywhere. You scoured locally first and then spread outwards. But what you weren't going to compromise on was the cash on cash return you were looking for. Appreciation, you kind of fell back on a little bit. Then you went the next step, which is, okay, I'm looking at single family homes specifically because I like the profile on them. And my
Mhm.
strategy is to keep good tenants in there for the long term and minimize turnover costs. Um, Before we get into the management of this, right? How many properties you first started off and how that kind of grew with a team. I want to get a little bit into what I know a lot of folks in the Gravy Network are dealing with, which is high earner, super high, federal tax rate, and likely to also have a high state tax rate as well. Can you give us a little bit of how you thought about the tax benefits? And I know that there's kind of the real estate professional with the spouse. Give us some of the cheat codes, if you will, to really supercharge a solid strategy for buying cash flowing properties so that at the end of the day, your wealth creation is accelerated.
Yeah. So the tax piece was very, very important as a reason why I decided real estate was the way to go because it's very tax efficient, didn't have any deductions at the outset. It was me, my wife, and one child at the time. And so yes, real estate is very tax efficient. And the thing that helped us is that instead of kind of because if you don't have a real estate professional designation, you still get the tax benefits, but it's kind of held until you sell or held until you get the real estate professional designation. So for us, it worked out well. My wife, when she decided to leave the workforce, she became a real estate professional. and she was our designation. So she really saved us quite a bit of money by taking on
And
that
just to
designation.
break it down for people to know, can you just help
Yeah,
explain in basic
yeah,
terms what the real estate professional means, what it entails, and the benefits you get from having that partnership? And again, it comes down to alignment. You and her were
yeah.
aligned. That was something she had to be aligned to make happen.
Right, right. So I don't know the exact wording, but you have to kind of have a certain number of hours dedicated to real estate activities, right? And so in some cases you can be a broker, sometimes you can be an agent. In some cases you can kind of just help manage the properties, but you have to dedicate a certain amount of hours every year
Actively,
to real estate
actively.
actively to real estate. And so once you get that, then any losses you generate from that real estate portfolio is deducted as above the line income, above the line from your income on your tax returns, which is huge. It's not just a deduction, but it's a direct subtraction of your W-2 income above the line on your tax return, which is huge. And so that was Nicole, and she did that as a joint filer for our taxes for many years. And the benefit though is again, so any depreciation on your property as a real estate investor is deducted as an actual loss on your tax return. Any expenses related to the management of that property is deducted on your tax return. If you decide to have a home office that you kind of use as a place of work to kind of manage the portfolio, that can also be deducted on your tax return. So there's many ways to creatively and legally use the real estate portfolio to offset your W-2 income, which was huge for me over the years.
Got it. And to kind of double click on the biggest takeaway here, it's unlocking a huge way to lower your taxable W-2 income, right? There's not many ways to do that. And through that partnership with his wife stepping out and kind of meeting the criteria to basically offset his W-2 income with losses, whether it's depreciation or what have you, and expenses, that was a major accelerator of the financial benefits, which I would argue the key measurement of that is your effective tax rate. Would you agree with that, AJ?
Exactly, exactly. And the other big benefit of the real estate is that you can do what's called a 1031 exchange. So if you sell a property and instead of having being taxed on those proceeds, if you roll it into another like property within a certain time frame, that's 100% tax free. And so you could, in some cases, keep rolling it over and not pay any taxes. And when your beneficiaries inherit that property, they get a step up in basis, and so effectively your family does not pay any tax at all if you keep rolling it over. So that's another huge benefit where if you choose to sell a property in real estate and you decide to roll that into a like property, you get to suspend those capital gains in some cases into perpetuity.
And this is a major generational wealth play. You could argue it is
Yeah.
the generational wealth play. And we'll spend some more time diving into that element in
Mm-hmm.
201
Mm-hmm.
with AJ as well. But kind of getting back to what I would consider to be the key metric that will resonate the most with largely the Gravy Network being high earners in
Mm-hmm.
high tax states. Can you just give us a rough, what was would you say your effective tax rate before you implemented your real estate portfolio strategy fully? And then it was fully optimized while you were still a W-2 employee. Can you just give us a comparison on like just roughly what you think the rate difference was?
So I was getting taxed. I was getting taxed before at a pretty high rate. I was like in if I counted federal and California, it's like in the 30 plus range. But over the years, it's gotten down to 10 to 15%.
Which is insane. So think about
Yeah.
that.
Yeah.
That's 25% per year
Yeah.
of a decrease in what is in taxes, from a generational wealth perspective over time, compounding that
Yeah.
money invested back into the business or otherwise. I mean, that's you could argue is what got you to retire at 52,
Yeah.
even
Yeah.
faster than just having a passive income alone. So I just want to highlight that because I think in my mind, the effective tax rate is such an important piece of the generational wealth equation. And as we
Mm-hmm.
know, the US tax code is built largely on entrepreneurship
Yeah.
and capital allocation as ways to lower that effective tax rate. Okay, thank you for
Mm-hmm.
walking us through that. I think it was an important piece to kind of double down. Let's
Mm-hmm.
get into your on the ground tactics. You're a busy corporate executive, right?
Mm-hmm.
You're managing teams. You're getting hit up by the executives, the CEO, with urgent projects. You have a family. Walk us through how you actually were able to scale this out from your first initial properties into 5 units, 10 units, 15 units? What systems did you put in place? How did you approach this over the marathon, right? The long term as something that you could really scale up?
At first it was helter skelter. I got to be honest. I didn't have a system in place. I didn't quite know what I was getting into. Because I had three young girls at home, a busy job, wife. I was also heavily involved in my church as well in the finance committee, doing a lot of stuff with them. And so it was just a bunch of nights and weekends initially. And I built the spreadsheet that kind of started to grow and grow and grow, but it became unwieldy. And it was causing me, it wasn't very helpful. And then the calls kept on coming in at sporadic times, et cetera. And I was very reactive in my portfolio. So I'd get a call and kind of say, okay, yes, no to this repair, that repair. And I wasn't really on top of like how my property was doing. I didn't review our statements that came in every month, et cetera. And so about 4 years into it, when I had about 8 properties, I said, this has got to change. And so I said, okay, let me treat this like a project, right? I'm great managing kind of M&A projects, strategic projects. Let me treat this like a project at work. And so I took all the skills I gathered from my corporate career and applied it to my real estate and treated it as a business. And so once I kind of had the mindset to treat it not as a hobby, but as a business and as a project, it changed everything. Okay. So I became more proactive. I set up with the property manager, I set up kind of bi-weekly or bi-monthly calls to talk about how my properties are doing. We had an agenda. I reviewed the statements every month, and that was kind of part of the agenda to look at that. We talked about renewals, we talked about vacancies, talked about repairs every 2 weeks, and that helped. And then, as opposed to having a spreadsheet, I kind of put the information into a database. So it allowed me to do better kind of quantitative analysis on my returns, vacancy rates, rent growth, et cetera. And so being able to have that database, I was able to look at things in different ways. So for example, there was one tenant that we hadn't raised the rent in about 5 years, 4 or 5 years. That with my spreadsheet, I wasn't able to pick that up, but within the database, it helped do that a lot easier. And so then I also started to devise time where, how do I manage my calendar? So I started to wake up a lot early in the morning time. I started waking up at 5 in the morning because I'm an early bird. And I said, okay, I'm going to try and minimize any kind of disruptions in that morning time because the kids were not up, Nicole's not up. And so I spent a lot of time in the morning time working on corporate stuff and also the real estate portfolio. And then I try to kind of carve out no meetings on Fridays, right? So I got some more thinking time for my corporate job and spend some time in the real estate portfolio as well. Once I started to better manage my calendar and put in place the protections on my time, I could devote more time to the corporate stuff and also to the real estate portfolio. And as I kind of started to scale, it became more easy. So the property manager knew how to deal with me. I knew how to deal with them. And my job became, how do I manage the manager? And then it became a lot easier to do that. So I think that the proactive time management, putting stuff into a low code database, and then making sure that I kind of had that mindset that this is a business, not a hobby, that changed the game for me when it came to managing the portfolio.
Systems. Okay, so we had a question that came in, and it was around what price point were you looking at? So of course, if you're looking in the California Bay Area, you're not spending less than $600,000 on a property, right?
Mm-hmm.
Hard to cash flow that. When you were kind of looking, there was obviously the cash on cash returns, but how are you financing these, and what was the general range at that time, right, for the properties you were looking to buy?
Yeah, so it really depended on the market. So in Texas, the price point was about 100K for a single family home. In Wisconsin, it was closer to 80K, 70 to 80K. In Muncie, Indiana, it was closer to 50K.
And then
So it kind
finance,
of depended.
were you buying these all cash? Were you putting mortgages on them to begin?
Yeah, so good question. So in Texas and Wisconsin, I was buying them with leverage, typically 20 to 30% down. In Indiana, I financed that with a margin loan, and which I kind of operated myself, and I put down about 20% down on the margin loan there with 30% amortization. So the amortization rates were in Texas is 20-year amortization, 20-year term. In Wisconsin, same thing. It was actually a 20-year amortization, 15-year term. And in Indiana, with the margin portfolio, I kind of put on my own a 30-year amortization with these loans. And so the good thing in Texas, the interest rates are fixed. In Wisconsin, it's also fixed as well. The margin loan, the one thing about using the margin loans, it's going to be variable. So you got to be careful with that. But for the most part, they're all leveraged. And, about 10 years ago, I paid off 2 properties And I felt that was a mistake. I
Mm,
felt like the return on equity was lower when I paid the two parts. I felt that I can get more cash flow, but if you look at the return on equity, it wasn't quite where it should be. And so I think that I've really tried to focus on keeping the leverage in the property and using any excess cash I have to just reinvest in other things. And so I'm a big believer in having leverage in the portfolio. There are people though that's been very successful that believe you should pay everything off and
mhm.
get more cash flow. And so it kind of depends on how you think about, like, do you want to sleep well at night or do you want to eat well? It depends on what you want to do there. But I think there's two rules of thought there.
Sleep well versus eat well. So and again, you threw out some 201 concepts, which is taking margin on existing stock and assets that you have, taking a loan against those up to a certain percentage to
Mhm.
fund the acquisition of a property that's going to deliver a higher return than what the interest you're paying on that loan is.
Correct.
PJ has kind of given me some game on that to help build out my personal portfolio, but that's something that we'll dive into at a later point. Okay,
Mhm.
thank you for kind of breaking that down. I think people want to kind of just frame where were you? Was there some rule around just the cash you had available? You want to go past that, kind of that point allocating to the portfolio. But back to systems, you woke up at 5 a.m., right? That was kind of, you gave yourself more time to work with. You moved from Excel spreadsheets to a database. Let's just kind of talk about these tools from a really tactical level. What would you recommend someone now kind of being the core tool set that you should have, knowing what you know now, to run your business, to minimize inconvenience, friction upfront? What are the things that you would recommend that people put in place from a systems perspective starting out?
Yeah, I think it's important to have a online to do list. This has been huge for me. So I use kind of Tool Do, and it's a great way to just figure out, okay, what do you have to do work on today, next week? You get reminders. You can look at it by categories, look at it by days, and so having an online to do list is huge for me. Number two, I think if you have like 10 units or less, you can probably still get away with doing it in Google Sheets, right? You can kind of put everything in Google Sheets and can look at your portfolio that way and still be fine. You got to have two models, the quick and dirty model, the more detailed model, to quickly evaluate these properties. I think it's important to also make sure that you have a more proactive approach to the management of the property. So talking to your property manager like on a cadence every 2 weeks, maybe every month, et cetera. That's important. I think those are some of the key tools that really help me to be more proactive in managing the portfolio.
Okay. So that's one part. The other part of it is your on the ground system. So you talked a little bit
Mhm.
about property manager. You talked about starting in state, but it seems like you ultimately ended up buying out of state and needed a property manager even from your first couple of properties.
Mhm.
Tell us all the members or kind of players on your team in order of most important to kind of, I don't want to say least important, but for the property's performance, what are the team members that you need to have in place, and then to the degree that you have to find best practices around how to know who to engage in these markets. Walk us through some of that learning that you picked up.
So the clear anchor tenant on your team on the ground is going to be a property manager. They can make or break your property. And it's important to really kind of fully vet this because it's like a marriage. You'll be with this person for sometimes, 10 years. I've had my Texas property manager for 15 years and they've been great. And so it's important to really kind of fully vet them. And one thing that we'll provide to the Gravy members is a list of vetting questions that you can kind of ask a property manager to make sure you're kind of getting the right property manager. But that's the anchor tenant. You got to have a good property manager. And for me, I wanted to have a property manager that would communicate with me frequently because I was kind of a new investor and I wanted to make sure that if I call, you call me back, or if I call, you pick up the phone. That was important to me. I also want to have a property manager that managed the asset classes I was acquiring. I don't want to have a commercial property manager that also manages residential. I want somebody focused on residential property in these zip codes where I'm going to invest in. I also want to have a property manager that was also focused on, hey, I want to get your advice on before I buy this property. I want to send it to you and get your advice on how hard will this be to rent? What do you think about this area? And so being able to help me vet properties too, because if you have a property manager that kind of has an investor mindset, that's able to help you vet properties, that's a bonus as well. So that's important for me. That's an important criteria for me to get a investor focused property manager that can help me vet properties as well. And then I also want to have a property manager that was tech forward. I don't want to have like manual statements. I want to have stuff I can see online. I can kind of download and kind of analyze. And so I don't want to have a property manager that dealt in paper. I wanted something that was totally electronic property manager. So those are some of the things that were important to me in picking a property manager. And the last thing I would say is I want to have a property manager that was been in the business for at least 10 years, 15 years. I don't want to have a new property manager that's trying this out for the first time. I want somebody experienced that's kind of understands the ebbs and flows of the market. That was important to me. So that's the anchor tenant. Second is the realty team. You got to have more than one realtor that's going to help you find properties in this market. And you have to get an investor focused realtor. There's some realtors that deal with kind of owner occupieds, but you want to have an investor focused realtor that deals with investors all the time, especially out of state investors, because they know how to communicate. They know how to send videos, how to send pictures, how to be your eyes and ears on the ground. And so I had about a half a dozen realtors in each market that would send me properties. And the thing about realtors, you have to be very, very specific. You can't say, I want to buy a single family home. You have to say, I want to focus on 3 bedroom, 2 bath, at least 1,500 square feet, and these 3 zip codes. Because the more specific you are, they can kind of put screens on their systems to send this stuff to you automatically. If you stay general and very generic, it's hard to action that for them. And they kind of lose track of you. So be very specific with the realtors in those markets. So half a dozen realtors. Next on the list is having a very reliable contractor. And having the contractor helps because it's a check and balance with the property manager, right? Because most property managers have their own contracting team. What I've discovered though is they tend to overcharge you. And I always kind of give it to my contractor first, say, listen, give me an estimate on this HVAC repair. And then I compare it to my property manager, and 9 times out of 10, that contractor is going to be a little cheaper. So what I've done in Indiana in particular, as I said to my property manager, don't use your in-house team, use Walter, who's my guy. And Walter's reliable, he's fast, et cetera. So in some cases, you can use the in-house contractor, the property manager. In some cases, you may use your specific direct contractor. But having a contractor is important to have on your team as well. Next up is having a good banker in your locale, in your market, because the banker is going to help you understand the lending criteria, what the rates are, how much they can lend, and have that relationship with that banker in that market is important as well. And then finally, on the legal side, I like having an attorney on call. I think that most property managers have their own kind of eviction team, but I like having my own attorney to help me with any unusual issues, things that may happen in that market. And so having an attorney in that market helps. It's not a necessity, but something that I like to have as a backup.
Wow. Lot of value packed in there and definitely appreciate it. You were obviously very intentional in terms of doing market analysis. You're looking at, and I actually want to get the tools that you're using. So you mentioned we talked about potentially giving the network maybe a list of those tools. But when you're doing your research and you kind of hone in on a market, how much time are you spending on the ground to recruit these folks that are ultimately going to comprise your team? And even after that, once you have the team in place, how often do you have to go to these markets? Again, if you're out of state.
So typically I spend like a few days in the market that I'm investigating and meeting with the property manager. All these meetings are set up ahead of time before I go out there. So when I go out there at these preset meetings, we typically can have a meet and greet with the property manager, meet and greet with the contractor, meet and greet with the realtors, and then we go see some properties and see neighborhoods. So I can get a sense of the neighborhoods and the properties, et cetera.
Not
Um,
together or individually, you're going on these trips.
so typically it's the property manager and realtors sometimes. Most of the time it's individual with the property manager meetings and then realtor meetings and contractor meetings.
Okay.
And I spend a few days in those markets. And then after I get comfortable with that market and the team, the folks that I've met, there's more like it's more like an email, call, Zoom call conversation with the team. And so I typically go to the in market maybe once a year, once every couple of years. Initially, when the online tools weren't as sophisticated, I go more often. But over the past 10 years, the online tools have gotten more sophisticated. You can do like 3D tours, et cetera. I've had to kind of go in market less. And so I really have enjoyed not having to fly to thing, but I still go like once every year, once every 2 years in market to kind of see what's going on, see my properties. In some cases, kind of the tenants want to talk to the tenants if there's an issue, but that's the extent of the travel to these sites.
Okay. If you had to estimate like how many hours from the beginning you were spending, and I know it was a lot more because you hadn't really built the systems, ran it like a business, as you said, when you were building, kind of getting this thing started. And then towards your, your later years in corporate, how many hours per week were you generally spending managing your real estate portfolio?
So I would say initially, no systems, kind of still investigating markets, like up to 10 hours a week doing that. And that's kind of slowly kind of gone down to like maybe an hour or two a month right now.
Wow. And I was in corporate, not right now,
Yeah,
but
yeah,
corporate. Wow.
right.
So there's a few lights at the end of the tunnel, right? Where it's,
Yeah.
you obviously have the financial freedom, but there's a point where if you have enough systems in place, you can really have the minimus time commitment associated with these things. That being said, I don't want to paint this super extra rosy picture. I know it's important to you to also reflect a realistic picture of what folks are getting themselves into. Can you share a nightmarish scenario that you can recount over the last 20 years you've been building this portfolio? Just kind of scare people away healthily so they know what they're getting themselves into.
Yeah, so even before I say that, I think that the important element also is that, instead of having like 10 markets, I focused on 3 markets. I think that like having 1 or 2 homes in 10 markets is like to me unsustainable because you have to master these markets.
No
And so
skills.
once you master a market, you feel good about it, invest as much as you can. And then what ends up happening is like for example, you'll get shut out of a market, which is not a bad thing, right? So I'm shut out of Texas. Prices have gone too high where I can't afford to buy in Texas anymore. Prices are too high in Wisconsin. I can't afford to buy there anymore. And then, yeah, so my choice now is, do I want to stay in these 3 markets and just optimize up my portfolio, or do I try to find another market? And so that's the decision I have to make. But again, it's important to find a market you like and then go whole hog in that market before prices get out of control and then move to the next one. As far as the nightmare stories, I got a couple, man. So one is, this may not be surprising, but a dishonest contractor in Indiana. I mean, this guy, I tried to do all the homework I could. He was referred to me by a trusted realtor. I thought, he was going to be doing some good stuff, and I sent him some money. I said, listen, here's half the money now and half the money later. Here's the money you have to use for the materials. And then he would send me pictures, but the pictures were sent in a way where it was very misleading. And so I finally had to have my property manager check him to say, hey, listen, this guy's taking a long time. Can you go there by there and just do a walkthrough and see what's going on? And the property manager sent me the real pictures, and this guy didn't do anything on the property. And then I called him, didn't answer. Emailed him, no answer. And so I finally said, okay, I had to abort, and I had a decision to make. So do I take him to small claims court to get my money back? And it just wasn't worth the hassle. So it was a complete write-off of several $1,000s with this honest contractor. And it's something that, had this been somebody that had I been in market, like living, like investing in my own backyard, would this would have happened? No. But that's the price of doing business as a remote investor. And I had to chalk it up as, lesson learned. And then the second one is um, my initial property manager in Indiana really started to decay. Right, initially, you think the first year was all good and everything was fine, but they I had a person that was dedicated to me because of my portfolio. That person resigned, and the new person I got was totally not on the ball. She wouldn't return my phone calls, wouldn't get on the bi monthly meetings, etc. She would actually put like tenants that had evictions on their record in my units, which was a clear violation of our agreement. I said, I don't want to have a tenant that had a prior eviction, but she said, listen, it's been vacant for a couple months. This is a quick shortcut. And so she did not have that because she sent me a description of this new tenant and I had to approve it. She did not have on that summary the prior eviction. I had to find out post after the fact when they got evicted again on my watch. And
Yeah.
so after this started happening over again, I had to switch to another apartment. So that was a waste of about a year and a half of just like pain.
It's not pretty, but
Yeah, yeah,
these are the bumps and bruises you have to take on the
yeah.
road to freedom. Okay, so
Mm-hmm, mm-hmm.
for the folks that are live, feel free to ping me more questions. But let's take a step back and kind of look at the macro. And AJ, again, I called you Yoda for a reason. You're someone who has a lot of knowledge of personal financial um, management at many different levels. And so I want to kind of talk a little bit around first your own portfolio, your portfolio construction strategy. All right. If you just have to just kind of broadly explain your allocations across different asset classes, just roughly back of the envelope, what would you say your allocation is and why.
Got it. Got it. So I do spend time really trying to think about this because I think it's important to think about the macro. So I'll tell you what the asset allocation is today and why. So right now it's about 36% real estate. This is a combination of real estate funds I invest directly in. This includes my real estate portfolio and my primary residence. 32% in stocks, primarily index funds like S&P 500. 15% in mortgage notes, and we'll talk more about that in a second, what that means. 10% in alternative investments. This is like venture capital funds and private equity funds, and about 7% in cash, right? And I think that for me, I kind of wanted initially my portfolio was 100% stocks, right? Before I started investing in real estate. And I felt I wanted to have an asset class that was not correlated to the stock market, which is why I said I want to have a portfolio where I have equal weighted stocks and real estate investments. And that's why I kind of have it as, for the most part, they're equally weighted in the portfolio. And then when it comes to mortgage notes, I used to be a bond investor and I thought bonds were great, but then over the past couple of years, bonds have performed terribly and the returns are quite low. But mortgage notes, which is basically you're being the bank, you're providing a mortgage loan to folks that are kind of doing a fix and flip or development, and because you have the first lien secured position in that asset, it's actually not as risky as people think it is. And so I've done this directly. I've done this through a fund, but being able to be the bank and be a mortgage note holder, which is earning 10 to 12%, is actually a pretty good. It's a pretty good way to return some money. And then I'm a big believer in having a decent amount of cash laying around, especially in this environment. We can get 4 or 5% on cash. It's not too bad. And then on the alternative investments like the VC fund and private equity fund, that's been a recent investment for me. I'm trying to get assets that are not too correlated to the stock market, and so it's another way for me to do that. But again, I don't want to have more than 10% of my net worth in these kind of investments.
What, if anything, are kind of the areas that you want to do more research into from a portfolio construction perspective?
It's a good question. I think I like the way it's constructed right now. I think that the new thing that I researched was over the last 2 years was the alternative investments and investing in real estate. Actually, you know what? Syndications is something that which is the same thing as real estate funds. It's something that I want to invest more into. And what I'm doing now is like I'm selling the underperforming um, units in my portfolio and taking those proceeds to invest in real estate syndications. And I think had those syndications been around 20 years ago, I think I would have started there first. Because investing directly is a pretty big leap and it's hard to do sometimes. And so if you think about crawl, walk, run strategy in real estate, crawl, walk could be investing in the syndications that's aligned with your strategy, getting a taste of what that feels like, and then kind of doing it direct. And so I think that I'm starting to invest more of my real estate funds into syndications versus direct.
Yeah, and I know you participated in the Harvard Enterprise Research Campus
Exactly.
from the Gravy Syndicate. So I
Mm-hmm.
see that strategy kind of taking place. Um,
Yep.
what advice would you give the younger version of yourself, early mid 20s, that you think would have most, obviously doing well, would have changed your trajectory even more so?
So one thing I would have definitely done differently, looking at my younger self, would be investing in a dividend portfolio. I think that earlier, right? So I've done that, when I was in my mid 30s, 40, et cetera. But in addition to the passive income from real estate, I think I would have invested in a dividend portfolio much earlier because that gives you more time to compound, and it's 100% passive. And so for me, having multiple passive income streams has been the key to getting to where I am. And so investing in a dividend portfolio earlier, investing in real estate earlier, I wish I would have done that. And so that's what I'm trying to get my kids
Right.
to help understand. But these kids, man, that's a whole nother conversation. But I'm trying to get my kids there, and so one kid is there, but the other
Uh,
two are still not there yet. So
so let me
so
let me
so
ask you,
you
because
got to
that,
start
that was
early,
actually
man.
the next line of questioning, right? Gravy's all about building generational wealth. You have a wealth of knowledge, and the kids' conversation is actually real. what do you, and obviously a lot of what you've accumulated you could pass on to your kids directly, but what are you looking for from your kids? Like, what is your ideal um attributes you like to see in your kids to help carry on the learning, the, the investments you've taken on? Like, help us understand what you think the win is in terms of translating all of this over to your kids and then their kids.
So I want my kids to be financially literate. That's the bottom line. I want them to understand how to budget, how to save, how to invest. I want them to understand the trade off between instant gratification and delayed gratification when it comes to their finances. And so if I can get them to that base level, they can develop their own kind of financial personality. That's great. I don't want them to be like me or like their mothers because we're different people, but I want you to have that baseline knowledge of being financially literate and understand all the tools at your disposal and pick the ones that fit your personality, your profile best. But I think that not having that knowledge, I think, would be a disservice. And so the funny thing is, like I tell the kids this stuff, and sometimes they listen, sometimes they don't listen. But their friends are coming to me asking me for advice all the time. I said, your friends are coming to me, but you have all this knowledge in house. You don't take advantage of it. But no, I think they all have bank accounts, all have credit cards, they all have investment accounts. I wish they would invest more because I told my middle daughter she loves Chipotle, right? And I said, Cameron, if you look at your spending for Chipotle over the past 3 years, if you would have taken half that spend and invested in Chipotle stock, you could have been 10x where you are right now. And so I'm trying to get them to understand, don't just consume the money,
Right.
invest the money too.
And and with that being said, AJ is someone who I said has a lot of knowledge in a lot of areas that people just generally just don't, you just don't know what you don't know. And that's kind of what we're helping to illuminate. So we'll be doing a lot of stuff with AJ. He's going to be in our pilot for an expert network where there's a lot of things, board directorships, building a level as a senior executive, and how do you manage that? There's a lot of things he has to offer, and he will be available to offer advice through this expert network. But specifically, I think an area that is undertapped is his ability to help you understand how do you build this portfolio of real estate as a hardworking corporate professional in a way that gives you options, gives you freedom, gives you control. And I want us to really unlock value through matching AJ with folks in our community who are serious about taking that journey. So look out for a lot more to come on that front. AJ, you're in retirement, but you're not really retired. Is there anything that you want to highlight for the network that you're doing or working on that you would like people to pay attention to?
Well, I think in addition to some of the access going forward, I think we'll be providing kind of some of the models I built. We can share that with the team. We're gonna put together kind of a vetted list of folks that I've worked with on my real estate teams as well, if that's of interest, and also kind of talk about some of the specific investments I've made, these different companies. As far as what else I want to share, I think that again, I want to have everybody in the Gravy Network be financially literate. It's surprising. Like when I talk to folks in my network who are senior executives at large companies who are very smart, they're not financially literate, and they're in their 30s or 20s or in their 20s, and I think that's a shame. And most of the time, these are people of color. And in order for us to close the wealth gap between Black and brown people and white people, we have to become financially literate. So that's why I'm working with Brandon. That's why I'm working with several nonprofits as well on financial literacy. It's important for us all to be financially literate as a baseline, and that's the first step in building wealth. So that's important to me.
Well said. Couldn't have said it better. And AJ's been a good friend for a while, and he's kind of been a day one Gravy value creator. Excited to do a lot more collaborating with him. We will follow up with a bunch of the resources he talked about, but I just want to say thank you, AJ, for one, just being an inspirational example of that a lot of folks can relate to, and laying out a blueprint that a lot of folks can follow if they so choose to, focus on that goal and put in the work. And so with that said, one last time, thank you, AJ, for taking the time. Really appreciate it. And until next time, thank you everyone that joined the call. We will be in touch soon. Take care, everyone.
Thanks. Bye bye.